This is Sarah Cage, and I'm joined by my co-host Adam Olson, Embark's National Quality Leader. And today we are also joined by Sam Sorenson, a Senior Director here at Embark, who has experience in today's topic, which is SPACs. We're going to cover as much as we can about the SPAC attack, because we've had hundreds of IPOs through SPAC in March alone. So we're going to cover this topic, which has a lot of complexity, but we're going to try and touch on the most important parts. So let's dive in with the most basic question. What is a SPAC?
You want me to take that one?
Adam, yes.
Yeah, so SPAC, is, the abbreviated word for special purpose acquisition company. And it's basically, a shell type company that it, like you said, raises cash or capital through its IPO with the end goal of finding a target, which is generally a domestic private company, although occasionally there could also be a foreign private company, a target to acquire and merge with. SPACs they're publicly traded entities. So they're getting outside investors, and they are subject to ongoing SEC reporting requirements. But that's generally what they're there to do, is really just to find a target and merge with that target.
And is this like a rebranded blank check company? Blank check company kind of sounds a little more sketchy. SPAC sounds a little bit cleaner.
Yeah, it's they've been around for a while. There's obviously a ton of buzz today. We're hearing more and more about it, but the concept of a SPAC's been around since, I think the early 90s. They had, a recent renaissance just, with lots of investors getting kind of amped up about it. And we're seeing celebrities getting behind SPACs nowadays. So that garners more headline news around SPACs. But, with the financial crisis in the early 2000s, that really kind of put a damper on them. So they kind of went away. And now we're just seeing that resurgence come through. And, like you mentioned, there's been hundreds of SPAC IPOs, just in 2021 alone. 2020 was a big year. And so will the trend continue? Time will tell, but it's definitely something that investors have been excited about.
And you mentioned celebrities, and I know that Shaq has a SPAC, and I think that's just fun to say. I'd like to be a part of Shaq's SPAC.
Yes, easy branding for that one, I think.
Sam, this one's for you. Why might a private company explore a SPAC transaction instead of going through a traditional IPO?
Yeah, so there's several reasons why. One of them, probably the main reason, is it's a lot faster than the traditional IPO, where that could take 6, 7, 8 months. These SPACs can go pretty quick. The upfront price, so that's set as part of the negotiated price before the transaction even closes, whereas in the traditional IPO, it's just driven based on the market at the time of the offering. Then there's the cost aspect. So with the traditional IPO, there's a lot of expense that goes into the road shows, marketing to get the attention it needs. And then, the potential leadership that would come through the SPAC. So a lot of the sponsors of the SPAC, they either have experience within that industry or financial experience that would come into play after the companies merge together.
Okay. And so why might an investor want to invest in a SPAC over another form of investing?
Yeah, it's kind of in tandem with Sam's last point there. I mean, one is obviously access to seasoned veterans, financial leadership, prominent investment bankers, PE guys that are essentially looking to source the deal. They're the ones that are negotiating, trying to find these targets. So they're buying into that expertise for sure. Another incentive is when investors buy a share, or they're called units when the SPAC IPOs. It includes, one share of common stock, but with that unit also comes a fractional warrant. So obviously the warrants allow the investors to, exercise those warrants and get additional shares of the target company once they're identified. But it's essentially an additional benefit to kind of reward them for locking up their capital while the SPAC searches for its target.
Okay. And so we covered the advantages of going public through SPAC. What are some of the disadvantages of a SPAC?
Yeah, there's always upside and downside to everything. So everything can't be as great as it sounds. So there are definitely some disadvantages of why someone might not want to do a SPAC or not invest in a SPAC. The first one relates to shareholder dilution. So what we mean by that is that, Sam mentioned these sponsors, they form these SPACs, and then these SPACs go and IPO, bring in outside investors. But as part of those sponsors forming the SPAC, they have these founder shares, which ultimately convert into 20% of the common share of the SPAC once it IPOs. And so that adds to some dilution there. Also, a lot of times the SPACs, in addition to the public warrants that they sell to investors, they also have private placement warrants, which can add to dilution. So there can be some shareholder dilution just in general. Also, there's a redemption concerns that can exist with SPACs. So basically what could happen is if a target is identified, shareholders may have the option to not really kind of go along with the deal, but maybe redeem their shares. And so, the SPAC itself has to fund those redemptions. And if they don't have enough funding to fund the redemptions as well as close the deal of acquiring the target, they may have to find additional financing somewhere, whether it's issuing preferred shares or taking on debt or something, some combination there to bridge the gap. So that's another one. And then, the last one I think is, people are always like SPACs are a faster way to IPO, and that's definitely true, but faster doesn't mean easier. And so a lot of times the compressed timeline puts a lot of pressure on the target companies. So there are these privately owned businesses that are now having to kind of run amok, fixing financials and getting just, updated disclosures, getting re-audits done, all sorts of stuff in a very short time period. And so a lot of the stress there falls on those private companies.
Yeah. Compressed makes me think, probably 1,000 hours of work that doesn't spread over multiple months is getting condensed.
Sure.
Can you give us a high level overview of how the SPAC process works? Like, what are the key steps that they go through?
Yeah. So there's, it's, a lot of people refer to this as like the SPAC lifecycle. So there's really kind of three key phases here. The first one is the Spec Formation, which we've touched on a little bit, which, essentially is when the sponsor creates the SPAC entity. They are put in a very small amount of capital to form the entity. They get these, small seed financial statement audits done. They file their S1s. Those get reviewed by the SEC. When they're ready to go, then the SPAC is going to, initiate its IPO, which during the IPO, like I said, they get investors to come in and invest in the SPAC. They're trying to excel their expertise. They may be experts in a specific industry looking for specific types of targets. So investors may be intrigued by that. Those investors will get, their units. So they get that share and that fractional warrant. And so, once that all happens, then that target search starts next. But while that's happening, the SPAC itself is a public company. They've filed their S1, they've issued their shares. So they're subject to all the ongoing reporting requirements, of the SEC. So they got to issue their 10Ks and their 10Qs and stuff like that. So there is compliance stuff that's going to happen as well once that SPAC is, kind of going through that target search.
Yeah, and the second step in that is, the target company search. So typically a SPAC has a lifespan of 18 to 24 months, and that's start to finish. So identifying the target company all the way to completing the acquisition. And so within that, so after they identify the target company, they're looking to execute a letter of intent, complete the due diligence, negotiate the terms of the acquisition, and that includes like the governance structure, the organizational structure that they'll go through. And Adam had spoke earlier on disadvantages, right? So as part of that, they also may go through, finding additional funding as part of that acquisition, which includes, redemption of common stock or additional debt. And so once that all kind of plays out, then the merger agreement's finalized, and then the SPAC company announces the transaction, files their 8K, and they're moving forward right quickly.
Okay. And then what's the next step? Is it they move into de-spacking? They've been spacked, and so now they unspack?
Yeah. So it's Spec Formation, target search. And then if it's, a successful de-SPAC is when a target's been identified, right? So that's, they've got that target, they've got the agreement in place. And so what the SPAC will have to do next is get a shareholder approval for that merger to take place. So they're going to solicit the shareholder vote for the merger. Usually this is accomplished through filing a proxy statement, or if there's going to be additional securities registered, they'll do this joint registration statement, which is like an S4 in lieu of their proxy. The SEC staff will review the proxy statement or the joint registration statement, very similar to what they would do for, a traditional IPO. So there could be comments and stuff that come on that need to be addressed and worked out. Once that's all cleared, the SPAC then goes and solicits the shareholders for the vote. They get approval on the merger. Once it's approved, like Sam mentioned, they're going to have to file that 8K, which, basically requires within 4 business days for them to provide the historical financial statements and associated pro formas. So if you think about that, it's, that's a lot of work that has to be done. And so, a lot of times as, keeping in mind that timeline of when, they get approval and they're going to have to file this 8K, there's a lot of like legwork that's already taking place with these target companies and shoring up those historical financial statements, preparing these pro formas so that literally it's all ready to go. And there's no time crunch trying to get this all pulled together because it would be, impossible.
Yeah, you said 4 days?
4 days. So
you can't do that.
And so, they got to meet that filing requirement. And like, Sam mentioned also as part of the de-SPAC, not everyone kind of goes along with the deal. So there also can be some redemptions that take place for people that either don't like the target that was identified, don't want to continue to invest in that and want their capital back. So there can also be some redemptions as part of that de-SPACing process.
So it sounds like de-SPACing is the big bulk of the work, and that's kind of the focus here, and requires a lot of effort. Can you give a summary, Sam, of what requirements are necessary to get the merger of the SPAC with the business, the target business or businesses, like how that de-SPACing process actually works?
Yeah. So once, the target's identified, they're immediately starting all this, all this work, right? So they issue this proxy statement, and they're basically doing that to get approval from the shareholders saying, yes, we agree to this business combination. They go through the details of the issuance of the securities. They'll elect the board of directors who they want to choose once the companies are merged, and then it'll go through the organizational and governance structures of the company. But within that statement, there's a lot of, additional work that goes into it, right? So there's the financial statements of the SPAC and the target company. Then the target company would also need to assess whether there was any, acquired entities or acquired companies during that time frame that they'll have to include in their financial statements. There will be unaudited pro forma information of the proposed acquisition, so what it would look like after the transaction. And then for both the SPAC and the target company, there's items in there, MD&A, risk factors, comparable financial information that they'd have to include. So it's a lot of work in a very compressed timeline that they're starting kind of once they've identified that target and start going down that road.
I imagine a lot of our listeners are probably the target company, and maybe they're the ones having to do this legwork. So Adam, could you walk us through some key accounting and reporting considerations they might need to think through?
Yeah, I mean, some of the more complex issues that come up, especially with the de-SPAC transaction, the first one is making sure we have the accounting acquirer correct. And that's applying the business combination guidance and trying to understand that. Other issues are around identifying who should be the predecessor entity, the SPAC or the target. How many years of financial statements do we need to include? So the number of years there, what do those need to look like? Kind of form and content of those statements can also be a little complicated because you're, historically, especially if you're applying private company alternatives under US GAAP, having to think about unwinding some of that stuff and also complying with Regulation SX. And then, not just on the accounting front, but also from an audit perspective, thinking through, historically AICPA audits. What does that mean going forward? How do we look at our previous audit reports and what needs to be done, change there? So those are just some highlights, I would say.
Let's dive into each of those then.
Perfect.
Let's start with the first one, determining the accounting acquirer. Why? That seems kind of like it would be obvious, but it never is.
Yeah.
So why is that important?
Yeah, so it's important. It's an important judgment that has to be done, determining who's the accounting acquirer. Obviously, in a SPAC merger transaction, can be a little convoluted because generally it's an exchange of equity interests, sometimes equity and cash. It's usually pretty obvious if like someone acquires someone and just pays cash under 805, they've got control because they gave them all this money, got the business. But in cases where equity is exchanged, it's important to evaluate, okay, who's really controlling the entity here? And so the guidance gives some like criteria to think through, if that's the case and what you need to like kind of look to if you're unsure about who's the accounting acquirer, which is important for SPACs because ultimately a SPAC does not want to be the accounting acquirer. Legally they may be the acquirer per the agreement, but from an accounting perspective, they're expecting to be the acquiree and the target will be the accounting acquirer. But to make that, conclusion, it's often looking at like, the makeup of the companies post combination. So, looking at the relative size of the entities, who kind of sits on the board and has, kind of control of the board, what's the management team structure size, looking at the equity, transferred in the agreement itself and trying to understand the relative economics there. And so, there's a bunch of judgmental factors. It's not a checklist, but it's usually like, a technical memo that has to be put together, basically to arrive at the conclusion that the target business is really kind of going to continue on and they're going to run the business and be in charge of the business. And it's not the SPAC itself. If the SPAC was determined to be the accounting acquirer, it would be a traditional business combination. So they would essentially have to apply purchase accounting to the target company's business, fair value everything, bring it on their books. And that's ultimately not what they're looking for. They're looking for what's called a reverse merger. And that's when, the legal acquirer is the accounting acquiree. So the target is acquiring that SPAC. And so what happens there is because the SPAC itself is not really a company, they don't really do anything. They basically just have cash on their books and, they're searching for a target and they're paying a couple expenses here and there. From an accounting perspective, they're not considered a business usually. And so if the target is the acquirer and the SPAC's not a business, it's really just a recapitalization transaction. So it's an equity event. So, there's less accounting complexities there. The target business doesn't have to fair value the SPAC and bring them on. It's really just kind of an equity fusion.
Sounds like a lot, like a ballet almost. You got to be careful about where you're stepping.
Yeah, it's definitely, like I said, there's a precedence here for like most of these transactions always result in a reverse merger. And that's how they're structured. That's how they've got governance, certain parameters in place to make sure that happens. It's really just kind of memoing that up and having those conclusions reached so you can get your auditors happy that makes sense.
Right. Because the last thing you'd want is to be trying to go through one of these and realizing at the end, oh no, we've done something wrong. We ended up with a business combination. I believe the next thing you mentioned was the accounting predecessor. What should companies keep in mind with that?
Yeah, so somebody's going to have to be deemed the predecessor entity. So, whose historical financial statements are we going to present in the ongoing filings? And so in most cases where, the target becomes the accounting acquirer, they're going to be deemed the predecessor. So the historical periods are going to reflect the target entity's financial statements.
Pretty simple there. So obviously creating financial statements is a big undertaking with any transaction, especially when the SEC is involved. So let's focus on the age of financial statements. Can you kind of walk us through the number of years required to be presented in the proxy and joint registration statement?
Yeah, so it's a little convoluted again.
What is it,
So it's either going to be 2 or 3 years that are going to have to be presented for the target. And it's really going to depend on whether the SPAC, which is often an EGC, emerging growth company, SEC designation under the Jobs Act, whether or not they've already filed their first 10K or not. So if the SPAC has not filed it, they contemplate this merger, the merger happens, only 2 years of audited financial statements of the target are required. However, if the SPAC has already filed its first 10K filing, then 3 years are going to be required.
So you're saying it depends.
It does.
It always does. Sam, what about the form and content of those financial statements?
Yeah, good question, right? So a lot of these target companies are private companies. So they'll need to go back and make sure that the financial statements comply with, the regulation SX and then the US GAAP requirements for public companies. And so that can be a lot of work for them. In addition to that, right, if the private company has, elected, alternative accounting for private companies like amortization of goodwill, they're going to have to go unwind that accounting and then revise their financial statements so that they can be included in the proxy or the joint statement. So there can be a lot of work there. In addition to that, right, they're going to have to then think about things like segment reporting and EPS to include. And then there's a lot of other items that they'd have to consider for redeemable preferred stock, things within equity that they'll have to consider. But most commonly, they'll need to go in and really consider the criteria under Regulation SX that, things like, are they going to have to break out different revenue lines on the financial statements, disclosures for income tax, tax rate reconciliations, identifying related parties. So there's a lot of things they'll have to think through and look at of what they would need to include in addition to, what they've already included. They'll have to go back and really just kind of beef up their financial statements essentially.
Yeah. And speaking of the standards for public companies, what about new accounting standards kind of coming down the pipeline? How does that affect the target companies and their need to adopt those with those different adoption dates?
Yeah, so this is one that always probably caused a little panic for that private company because they're like, what does this mean for me now? Like thought I had all this time, or this wasn't something I was looking at necessarily right away. So generally, a company that merges with a SPAC that isn't considered an emerging growth company would have to apply accounting standards in line with public business entities. However, if the SPAC itself is an emerging growth company, the target itself would be an emerging growth company if it conducted its own IPO. And the combined entity, which is going to be an emerging growth company, if both of those are in most cases, is an emerging growth company, then they can adopt any new accounting standards in line with private companies, so long as they maintain that emerging growth company status. And so, there's specific parameters of who qualifies as an emerging growth company. It really comes down to total revenues. It's roughly around $1 billion currently. It's like 1.07 billion, and then it has to do with how much debt they have issued and outstanding, if it's over a certain parameter there. So those are metrics that get looked at and have to be reevaluated. But so long as they can meet that criteria, they can stay an emerging growth company up to 5 years. And one of the, kind of benefits of being an emerging growth company is, not having to do kind of the accelerated adoption of these standards that public companies had to do. So, revenue recognition, they could adopt that technically in 2020 with the deferral we got last year. Leases would be a 2022 event. CECL will be 2023. So those are kind of the big three that people think about. But any others as well that would be already effective that aren't for private companies, they would be able to defer.
Okay. And so continuing with that same idea of GAAP and financial statements, can you talk us through the audit considerations that come into play as they're going through this de-SPACing process? That's such a fun way to say de-SPACing.
Yeah. So, one of the big things here, especially if the target company, right, is the accounting acquirer, they're ones that are filing their financial statements, the historical financial statements, the predecessors are the target company's financial statements. Oftentimes that's going to require kind of a re-audit because historically private companies, had their financial statements audited under AICPA standards. And obviously as a public company, they have to comply with PCAOB standards. So auditors are having to come in and do a lot of incremental audit procedures and testing, and they're looking at the additional disclosures and things like that need to go into the financial statements themselves, and audit those in order to reissue their audit report under those standards. So that's something they'll have to do. Another item we mentioned at the top of the discussion was around any potential significant acquired entities under Rule 305. So if the target company also had any acquired businesses in the reflected periods that needed to have separate financial statements filed, those could be AICPA issued audit reports on those financial statements because they aren't the reporting entity itself. So there is relief there depending on if that's something that companies have to deal with. But there are, the PCAOB standards a little bit different. There's different independent standards that auditors have to apply. There's different rules around affiliates and stuff like that. So it could potentially cause some issues, particularly if they had an auditor that may have done some services that were permissible under AICPA standards and now are no longer under kind of PCAOB SEC regulations that could warrant needing a change in auditor. So just some things to think through for sure.
Yeah. And Sam, once they have completed their de-SPACing, what happens next for the combined target company and the SPAC?
Yeah. You would think that after the merger transaction was finished and they were one company, they'd be able to take a breath and kind of get their feet under them. But really right after that, they're mandated to comply with the requirements of the SEC. So they're filing 8Ks, they're issuing 10Qs and 10Ks. So, and then there's a lot of stuff that comes after that with SOX and everything. So it really doesn't stop once the transaction is completed. They're just right into a different cadence of timing.
And you mentioned SOX, which is a huge part of becoming a public company. What should companies keep in mind here? And when do they need to start complying with those 404 rules under SOX?
Yeah, so we can kind of split it up into like the 404A and the 404B requirements. So 404A is like the management kind of representation around the internal control. So this one kind of depends. It kind of goes back to whether or not that SPAC prior to the merger had already filed its first 10K. If it had filed its first 10K, then it's already kind of on the clock that it has to do an annual 404A certification of management's assessment of internal controls. And that's because the rule itself basically states you have to comply with that in your second annual filing, so your second 10K. And since the SPAC's already done one, once they merge together, they're already on the clock. They consider that prior 10K filing as year one. And so now year two is going to be with this, ongoing target company being the public company going forward. They're going to have to comply in that first year. On the 404B front, we talked about the emerging growth company kind of qualification there. So long as the company meets that like criteria to be an emerging growth company, they'll be able to defer the need to have like an auditor, issue a report on their internal controls over financial reporting for up to 5 years, so long as they keep that status. But that being said, obviously they're going to be putting controls in place, getting that all shored up to comply with ongoing, SOX regulations and testing and things of that nature. So, a lot of companies will have that kind of underway, even, as they're preparing to do the de-SPAC, they may already be thinking about that type of stuff and trying to bring in outside help, to help implement new processes, look at, control gaps where they may need to do different things or shore up existing, controls, and reevaluate what all needs to be done in order to make sure they're squared away.
That's a lot to consider. Do y'all have any final thoughts just based off your experience working with SPACs?
I mean, I think it's a lot for a private company to take in. It's a compressed timeline. There's a lot of work to be done. And frankly, there's a lot of private companies who don't have this experience. So it's important for them to loop in the right people, to get help where it's needed, if they want to be successful.
Yeah, and I would just say, there's been some murmuring around SPACs, I would say, recently, just with the SEC weighing in, they've been warning investors about making sure they know what they're investing in. And so there's been a lot of eyes looking at SPACs, I think, just given all the volume of IPOs and buzz around it, just whether there needs to be more regulation. So there is a risk of, there could just be stuff coming down the pipe that could impact how SPACs are handled or some of the requirements of transacting with SPACs and things like that. So there are a lot of eyes on that. And, some investors may be wary about wanting to invest in SPACs, and, some investment managers may be wary about trying to start new SPACs because they can't find the investor pool to fund them. But all that being said, especially for target companies that are really hoping on a SPAC, come find them and and take them public. There are a ton of SPACs that have already been formed and have billions and billions of dollars locked up in these trust accounts that they hold the cash in while they're searching. And so, those SPACs are still looking for targets. So there are going to be a lot of transactions, de-SPACs, coming in the next 12, 18 months, whatever. As those entities search and close on deals, hopefully, in order to, bring those target private companies to the public space.
Yeah, well, I think the SPAC is here to stay. You could say the SPAC is back, but there's so much more we could cover on this topic. They're such an interesting vehicle to IPO through. And if you would like to learn more, we encourage you to check out our blog. Thank you for listening. We hope you found this discussion helpful. And Sam, thank you for joining us today.
Yeah, my pleasure.
And we hope to have you again on another episode of Accounting Matters.